Get Rich Slow with John Wolf. Hey, the kind of chaos outside with the financial markets and people not working, and the virus that's out there is causing a ton of impacts. And right now, I want to just try to explain some of why that's happening in the mortgage market. I literally just read a 8-page paper talking about what's going on in the market, what the government is doing, how the government is causing some substantial problems, and what relief my industry is asking for in that specifically. And I also want to tell you, I have seen this impact my operations personally. The way that it's done that for me is very different from most other people, but I'm trying to get a bunch of loans through right now. I'm sort of in a race to get loans done before my clients get laid off, is how I see it right now. And sort of tangentially connected to that, last night I was requested of me to save a deal from another lender because the client is furloughed, and that lender is a broker and they have an overlay where they will not fund a loan if the client isn't working. And they may even ask the client's employer to sign an attestation that says something to the effect of, our operations are not affected, we're not going to be closing. That's technically not required for the loan to be insured and to be submitted as a normal loan. And thankfully, I don't have to do that for this particular client's case. So I'm going to be able to help that person out. If you happen to know of people around who are getting loans denied, which all of a sudden, and you didn't think they needed to be, please reach out to me. I have found workarounds and my company allows them in many of those events. Anyways, I'm a loan officer in Oregon and Washington. Here's my license information. And I'm just going to leave the bond market ticker up because it is part of this discussion. I'm going to make a really short talk of an 8-page topic. So basically what's going on right now is right between basically the 23rd and Monday, there was a ton of demand from the market as people were taking money out of the stock market. They wanted to buy something safer. What's the safest thing more or less you can buy? Well, mortgage-backed securities. So then I called all my clients and I generated a ton of demand to fill that supply. And bingo, bingo, bongo, all of a sudden everybody else did that too. And now there are way more mortgages promised to the market than people want to buy it. And you see these red days where the price that you could actually get for selling the mortgage-backed securities is going way down and also being super volatile. And then the government stepped in here and they went way down again. The government stepped in here. And it looks like the Fed is just buying unlimited. And you wouldn't think that that's going to be great. That's going to support the mortgage market. But actually, it is going to destroying the lending companies. And I'm going to do my best to explain why. It's kind of complicated and confusing. Okay, so you need to know that there are 3 ways that money is made by my industry on a mortgage. So number 1 is origination. So I, with my skill and license, package a financial asset, which is the mortgage, and I make sure it's insurable, and that's a asset that somebody can buy and sell and be traded. So that's worth money. The next step is what's called servicing. So there's a bunch of my company services all the loans that my company owns, and my company is not a broker and it's not a correspondent lender. We keep almost all the loans we ever do. But anyways, normally after a loan is made, part of it gets sold to a servicer, and the servicer pays about 1% of the loan balance to get it. And then that servicer is paid by the other half of the loan, which is the investor, the person who buys this mortgage-backed security, about 0.3% a year. So they need to hold on to a loan for 3 years to break even. Now, here's what's way worse about that. If a client can't make a payment, the servicer actually still has to send that payment to the investor. So the servicer loses cash there. And if that's happening to a ton of people at once, that's a really big problem. So frankly, that kind of is happening, or it's about to happen. So the value of buying the servicing rights has actually gone down, because it makes sense. It's a math calculation, from about 1% to 0.5%. Now that's really important, because the way that companies determine what the credit line of lenders and servicing companies is as a fraction of their net worth. And their net worth is determined by the value of the assets. So if the value of all the assets they have just got cut in half, that servicing right asset, then they're going to be in a lot of trouble. This actually got worse from some government action. So I told you that, the government is buying all these mortgage-backed securities. Well, little inside baseball of how the rate lock and everything works. So on normal times, I call a client, we lock their loan, they know what their rate is, and the company is going to make good on the rate that we said we are going to, whether or not the interest rates get higher, in which case the company actually has to buy down the rate for the client in the background. Or if the market gets better, the company can actually keep a little bit of that profits. Now, we actually, as an industry, we actually hedge that. So because there are enough swings that if the rates go, we lock a rate, 30 days later, the loan gets made, the new interest rate in the market could be way higher at that point, and that could very quickly kill a company if we had to pay for that. So what we do is we actually bet against ourselves. So we hedge the investment that the rates are going to go up, and if the rates go down, then we make a little bit of money selling the loan that way. And if the rates go up, then we protected ourselves with the hedge. So that kind of like evens it out for us, so that we can stay in business and keep serving our clients. Anyways, the federal government came in and started buying a ton of these, and that has moved the price of the mortgage-backed securities up a lot. But what that has actually done to our industry is, since we were hedging, we were basically gambling against ourselves that this wasn't going to go up. Now the lending companies are having massive losses because of the Fed buying. So my industry is actually asking the Fed to slow down on this. Probably not stop, but seriously slow down. Another thing that has happened sort of tangentially to this is, we have basically three large types of loans out there that get made. There's, conventional conforming loans, which when you hear put 5 to 25% down, that's probably a conventional conforming loan. And then you have what we call Govi loans, and that's FHA, USDA, VA. And then there's a third category that's big, and they're just called super conforming or jumbo loans. And then there's a tiny, tiny category card portfolio, and we're just not going to talk about that. But among the conforming loans, the conventionals are very well insured for the investor and the lending company. And the people who are actually getting those loans are people who, have decent credit, have decent income, and had to put money down to do this. Where when you look in the Govi, the reason you'd get one of the Govi loans is either you didn't have money down and or you didn't have a good credit score, or some combination of the two. So right now, when a ton of people are getting furloughed and laid off, those loans are much, much, much more likely to have a problem. And there is a rule that compounds that issue for the industry immensely. So if I make a loan for you and I followed all the rules correctly, then, and 2, 3, 4, 10 months later, you miss a payment, I am protected, my company is protected from the loss, because it's going to be insured by the federal government. But there's actually a rule where if you miss the very first payment, the entire mortgage-backed security that loan was based on has to be bought back 100% on the dollar by the lender. So that doesn't have to happen very many times before a lender will just be completely out of cash and not able to fund loans. And I think we're definitely seeing that. Like I said, I'm taking over a loan from another lender because the other lender just imposed a new rule for a loan that they were literally going to close in a few days that makes that loan not qualify. I suspect that the real reason behind that is that lender does not want to take the liability of having the client miss that first payment. Or they just don't want to be doing Govi loans right now at all. Thankfully, I work at Caliber Home Loans. We are one of the best capitalized companies in the business. And since we buy all of our own investments that we originate, It's a lot less of a hit on the total balance sheet if that were to happen. It more affects the company's credit rating than it does the investment credit rating than it does the actual bottom line for this moment. So my company is able to survive that a lot better, but than most. But anyways, that's kind of what's going on. So we're in the weird thing where we're in the weird space where the federal government stepped in to buy a bunch of assets that we thought needed bought. And then they've moved the price so much that they're actually kind of killing us again. Anyways, let me know if you think I analyzed this situation correctly. It's definitely really complicated, and I did make a very short explanation of a very long topic. Anyways, please like, share, and subscribe to this video, pass it along. And if you appreciate it, I'm a loan officer in Oregon and Washington. Reach out to me, especially if you're in trouble right now. I actually love hard cases. I like digging in and finding new solutions. I found a new solution for a client who was turned down this morning from another lender. So anyways, also, I just forgot to mention jumbos. The jumbos are sort of in the same problem category as the govies, but for different reasons. Jumbo loan, we're talking probably more than a $600,000 home purchase. Good chance it's 1-2 million. And believe it or not, high earners actually don't have the most stable employment history over time. And those loans are not insured the way that the normal conventionals are. So the reason those rates have gone up is sort of like can I ask you a question? Like, hey, I know it's a time of financial hardship and stuff, but could I interest you in buying a not exactly prime mortgage-backed security investment, or do you just want the prime ones? Well, if you're going to do it at all, you probably want the prime ones. So that's why we are where we are. Anyways, have an awesome day. Like, share, and subscribe. Stay awesome.